Yeah. Hey, Bruce.
Cheers,
How
all.
are you,
Thank you.
How are you?
I'm great. Thank you
Good.
all. It's great to hear your voice. It's always fun to listen.
You have fans here.
Oh my gosh. Well, hey, I'm glad to be here. And I was going to hitchhike on a couple of the comments that Blake had made to start. But anyway,
Okay.
you're in charge of this railroad.
No,
Dale,
no. You can take it wherever you want. It's still America.
Well,
you can take control of the screen and say what's on your mind, Bruce. People have heard me blather for half an hour already.
Let me know when you can see my screen.
There we go.
Now I don't follow the currencies the way you all do, but I do follow them and more of on a long-term time basis. And you can see this chart on the left, which is just a lot more data. And I'm using the UUP, comparing it to gold, because I just want to compare the relationship. And you can see there the inverse relationship between the dollar and gold. And of course, you all were making the comment about how poorly gold has been trading. And you can see that the dollar has just been, stellar here since early July. And this is after, so big context, now we'll get a little white coffee in here. Distribution form back in 22, big leg down. Basically, we're range bound. So we're sitting here range bound in the dollar index. And we've just up thrusted these highs. And this is a really interesting place, and something I thought yesterday was a very important day on a number of different fronts. And I think the dollar was maybe the anchor to the whole thing. And so
when it weakened and yields weakened, everything reversed and risk on happened in a big way.
And I think there was a reason for that, Dale. And so if you go over just a little more granular, you can see on the right, you can see that we're just looking at fewer days here, but and admittedly, the gold chart is not updated for yesterday because it's an end of day chart. I did it yesterday, but as we all know, gold was up a little, silver was up a lot, and this was an outside day in the UUP. And I'm very curious whether it can go back down through this very important resistance zone. And this is still resistance. In Wyckoff, we call this an upthrust. And if this is redistribution in the dollar, this could be an upthrust after distribution, we call it, in a redistribution formation, which has been going on for. It implies that it's a continuation structure, and that we should get follow through to the downside that approximately matches the move that we had there off that very sharp climactic peak in 2022, September, end of the quarter. End of the quarter is very important to me. So anyway, all we can do is just see whether or not it shows weakness back through that level. And if it does, then very interesting. But a couple of things that happened yesterday, and now I'm getting a little off the technical, but in the Twitterverse, I don't know, or the Xverse or whatever it is, we'll all recall the banking crisis that we had in the spring, and the banking crisis, which was very difficult, disturbing for the market, but I think it created a bit of a reflation trade, and was really helpful to the market. And so here, this was one of the tables. Now, I'm not going to, we're not going to go through this, but one of the tables that was coming up, some very good analysis. I wish I could give you the person that did this, but it's based on Federal Home Loan Bank Board data. So it's an FHLB spreadsheet. And you can see those three banks in blue are the three banks that failed in the spring. And so if you look at FHLB loans to these banks, that Charles Schwab Bank, and I don't want to cause anybody to panic here. I don't think this is I don't think this is necessarily an imminent problem, or maybe never a problem, but it has a very high debt as a percentage of their equity. And now keep in mind, Charles Schwab Bank is not Charles Schwab Brokerage. Charles Schwab Brokerage is many, many times bigger, but Charles Schwab as a bank is quite large. And I think that there was all this buzz in the Twitterverse. And this buzz, I think, was something that may have set up the trading for yesterday. Because
you mean the turn in the bonds and yields coming down. This is an interesting table, and maybe you could answer this question. So I'm looking at this table right here, and I've been very negative Citi, and most of the banks. In fact, it's part of my bearish narrative. Citibank is a pretty low compared to others, 11%.
Yes.
And it's pressing new lows if you've looked at Citibank. So it's not just the regional bank chart that looks negative. The XLF looks like it broke down, and Citibank, if this isn't the problem of leverage, what is Citibank's problem that it's almost back at the COVID peak or low?
Well, and I think that the banking business in and of itself is not been a great business to be in, obviously. And Citibank, I think, has a lot of legacy loans in there.
The derivatives from 08 that never were just put somewhere in a box.
And other banks have similar problems. So these other banks have got some derivatives that, for instance, a big derivative exposure in the silver market.
Okay, and so that it's not just duration risk. There's all kinds of leverage risk,
and a lot of these
money centers.
A lot of these banks, especially the money center banks, which are receiving the assets, like Silicon Valley Bank, First Republic, they got folded into bigger banks. Well, the other thing that happens with these bigger banks is that they get their loan portfolios and they get their other portfolios. And so there is, the bigger bank that receives these assets has to work them out of their portfolio. And in some cases, they were maybe the reason why the smaller bank got into trouble in the first place, is because they got upside down on these very, very large trading positions. And in addition, and long bonds is the big story. That's what brought down these three banks in the spring. And and that's because of Fed actions, because of what the Fed did. And
then don't you think that Powell knew what he was doing, that these banks were vulnerable with the regime he embarked on?
Oh, there's no question. That's their job. They're
so why is he trying to kill the financial system and clear out all these banks? Is it for the introduction where people have no confidence in their own banking system that they'll accept the CBDC as a fix, Bruce?
Well, I've certainly read a lot about that, and I'm just not. I mean, I know some very smart banking people that are concerned about the possibility of the CBDCs, and I've tried very hard to understand, exactly what they're proposing. And
how are they going to sell it unless people have enough fear or under enough duress to accept it as a fix?
Well, and that could be where, if there is a larger banking crisis. But I think what may have happened yesterday, Dale, is that the Fed learned in the prior crisis in the spring that it's better to head off a disaster than it is to react to it. And that was the whole strategy with Greenspan, is he says, well, you can never anticipate where a market is extreme overvaluation. So you have to let the market go up and then break and then deal with, the aftermath. That was sort of their philosophy back in that era. Well, here, all of a sudden they discovered that, my gosh, these are three really big banks and this is contagious. And they had to solve the problem in a very expensive way after the crash. of those banks, a crash in the banks, not in the market. And so I think what's happened here is I believe that the Fed is very attuned to the subtext of what's going on, and they're seeing that there's still some very, very big banks, which shows up in that table, that have exposure that's comparable to the exposure that these other banks had in the spring. And this time it's better to head off the problem. And I actually think that what we may see, because the bonds yesterday were up more than the NASDAQ.
Yeah.
The long-term bonds
haven't seen that in a long time. TLT up over 2 points.
Oh my gosh. It was, yeah. And then a big outside day in the UUP, big day in gold. So you have silver, big, huge day in silver and a huge day in the bonds. They normally work opposite of each other. And so I think that maybe what the market was anticipating is that we're going to get maybe the Fed is going to back off their extremely negative exposure.
Hawkish.
Yeah, but they're not going to come out and say that necessarily. It may be vaguely in Powell's language tomorrow, but he's still going to talk tough. But I believe, but at the same time, there could be underlings, or there could be other board members or other ways that they communicate that they have, that interest rates, they may stop and watch for a while. And I don't think by any stretch of the imagination that interest rates are going to start to go down. The only history shows us that the only time the Fed starts to cut rates is because they're following the 2-year yield down, because the economy is in recession. And so you can see, for instance, in this chart right here, which is the yield curve, note that this is the spring right here. And look at how negative the yield curve got around the time of the big banking crack up. And it was over a -1% negative yield curve. So almost 110 basis point negative yield curve. And so, and this is 10s to 2s. And so now why is that significant? Why is a negative yield curve important? And this is the other point I would make here with this chart, and then I'll show you another one, is that look at the rally that's already started since the beginning of the third quarter, which is that you have a yield curve that's still negative, but it's
starting to steepen.
It's starting to move back towards normality, and not that it's going to get to positive anytime soon. This yellow shaded area just represents negative yield curve tight money. And tight money, Blake said it there here towards the end. He said, it's like the economy looks like it's still trying to weaken towards recession. And in fact, I think that is inevitable, is that sometime probably next year, because these things move so slowly, that we are going to have some kind of a recession. It might be mild, and here's part of the reason for that, is that if you look at this is the Fed data, and Cleveland Fed does great work on yield curve. And in every case, going back as far as they've studied, I believe, you'd have to go look, this data is all there for you to look at, is that a negative yield curve has resulted in a recession, which is the gray areas.
And this is the most inverted since 1980.
Yeah, there you go. And so here's the history all the way back into the 70s.
And the other crashes.
And so this likely is going, now, because of the Inflation Reduction Act and other things, the federal government does have money to infuse into the economy, and there's some pretty smart people that are saying this is helping to keep GDP in above zero. That the economy is still bumping along.
Atlanta Fed is talking 5% GDP.
Yeah, and I guess there's some statistical reasons for why we could get 5%, and they think some people think it's just a bit of a blip.
Yeah.
But I don't see that a recession is like in the cards for 2023. But as long as the yield curve, and the thing is that the yield curve, note, Dale, that the yield curve goes positive in these cases before the recession starts.
Okay. Yeah.
So it's a very slow moving train. And then I think that the analog is here, which if you look at this analog 2018 to the present to back in the 70s, 60s and 70s, there's very eerie similarities. Inflation was very low in the 50s and 60s. When the 60s got going, inflation started to ramp, and eventually it doubled and tripled into the late 60s. But as we know, and I was there, the CPI numbers just continued to go higher all through the decade of the 70s. And so I believe that we may be seeing something similar to the decade of the 70s coming, but that we're still relatively early in the game. So what I've done here in this data, 2018 to 23, which includes the COVID low, which I have lined up to the 62 market low, look at the correlation, look at the analog that sort of shows up here, and look at how we had this rally from 66 to 69. Well, this high right here was right into the 68 presidential election. Nixon's first term, just almost reached the highs of the bull market, which
just like recently.
Yes. And
wow,
so
that is really a cool analog.
Two-stage advance. And I think it's very possible that we could have this market at new highs, the indexes. And now I'm just looking at the Dow here, but does it, NASDAQ, S&P, these major indexes could easily be at new highs. But this is the big story, I think. The reason that inflation started to heat back up again in the 70s was because the Fed back then was alarmed about inflation, but then they backed off their policy because it was too hard on the economy.
Yeah, and Paul's nightmare. Yeah.
And so if there's a bit of a pivot here, because they're worried about the banking system and they don't want a replay of the spring, and they're already doing things behind the scenes to make sure that we have a smooth ride through here, because banking is all a confidence game. And when Twitter started to explode in the spring, and right when Twitter exploded with these, all of these stories, is when there started to be a run on those banks. And so this is what the Fed wants to head off, is a run on the banks. And so I believe that's, that would be their normal response. And so I wonder if the Fed is quietly and carefully going to, or is already starting a pivot, which is shown from evidence like the yield curve starting to moderate.
Okay. Well, if it's starting to moderate and head up, that's a negative sign, according to the analogs we've seen.
Well,
that's when the recession start.
Well, they're moderate, but they've already done the really, heavy lifting of tight money policy. So they probably put a recession is baked into the cake. And so, but that doesn't mean, just like we had in the late 60s, that we don't have a reasonably good advance in the market for a period of time, and maybe even get to new highs. And so, Blake had made that comment earlier. It's like, well, you got to be careful here. And I agree with him, because we're very close to the prior highs that were made back in 2020, 2021. And so here we are, we'll have a secondary test of this prior high, and even an upthrust of that high could just indicate that we're in a big range bound condition. Classic range bound structure that went on for more than a decade.
All right. Can I address what I think may be the elephant in the room? I know we're talking about cycles and what and the Fed is the main idea here. Can I talk about that China? The narrative is what they've done is weak in response to the economic weakness the country has, just those two interest rate cuts and devaluation of the yuan. And all of the Western central bankers are saying you have to do more, do some fiscal, do QE like we did. And is it possible that Xi, who doesn't face an election, is willing to accept the pain of a deflationary impulse to drag us down, just like they really took us out of the '08 recession by being the only engine of growth, that China is bigger than the Fed right now, and what happens there?
Well, I thought it was real interesting that China did pivot to a more easy money stance, and they have a tremendous amount of debt in their system, and so their debt problems, I think, exceed really anybody's. And so you know,
I guess the point is, if China could drag us out of weak growth like it did in the Great Recession, could it take us down? You know, America would get a cold, the rest of the world would get pneumonia. Maybe it's now China. If China gets a cold, the rest of the world gets pneumonia.
Well, and the thing is that if they continue to follow, right now they're kind of pivoting towards easier money, and so it's a first step, let's say. But the thing is that the thing about monetary policy is it tends to be a worldwide phenomenon, and normally the Fed leads the parade. And so if the Fed's getting tighter than and of course you can look at Europe, their inflation problems are even worse than ours, and so on. But if the Fed all of a sudden signals, and they all talk to each other, that they're going to pivot towards a more accommodative stance, then, and here's China.
Do you think the Fed communicates with the PBOC?
I can only guess about that. I don't know.
I mean, they don't communicate in any other way, militarily or anything. They don't pick up the phone. So I don't know. It's pretty opaque.
But I do think that like the G, however many there are, 7, whatever. I think all these big central banks are all in cahoots with each other.
Yeah, it's a club.
It very much. And so tight money, easy money, it tends to go together. And so if we start to see a bit of a pivot from Powell, you're probably going to see that in the other major central banks also. And so now we may learn a little something tomorrow. I think he'll still be hawkish in his comments. It's more about what they do behind the scenes. And we'll probably learn that in a month or two, but the markets will react right away. And because, if they're pumping, high-powered money into the system, that we may have seen that yesterday. And so
go ahead, Bruce. I'm sorry.
No, go ahead.
The U.S. dollar yen will tell you where rates are going.
And a couple of other things. I know we're running out of time.
It's okay. Take your time.
So here, for instance, this is a chart I really watch closely, and it's the and I show this on Power Charting, which is a show that I do for stock charts every week. But this is the New York Stock Exchange 50-day stocks above their 50-day moving average, and this is the NASDAQ stocks above their 50. And the one thing you'll notice here about the NASDAQ is that look at how really less vibrant the rally was in May, June, July. I mean, it still got up into the 60s, low 60s. But, you know, this, I think, was all the mega cap growth stocks.
Of
You know, the
course.
money, yeah, like what happened yesterday. And Nvidia, you know, Nvidia is now, you know, very much a mega cap. And then also over here on the New York, you can see that got up into the 80s. So over 80% of New York stocks, which used to be the blue chips, but now they're kind of teeny tiny compared to the mega caps that are dominating the NASDAQ. And they're also dominating the S&P index and other things. But what I look for is I look for divergent characteristics at key highs and lows. And that's one thing is, so you can see here, DNC, downside non-confirmation. And that means that you haven't, like here, for instance, this is 22, but this is June, July, a divergence. You have two lows here, and look at the stocks above their 50-day rising. Internally, that's showing improvement or repair underneath the surface, and it led to a really dynamic advance into the August peak. And you can see that happening in October, which was a great trading period, beautiful divergence. We had a really nice divergence in May of this year, and that led to a nice advance. And now you can see, look at a blow off, and then right there, early July, right into the beginning of the new quarter, divergence, upside non-confirmation against higher prices in the NYA index. Well, and in the NASDAQ, you can see something similar occurring, where it sort of built a top at a lower level, less breadth in the NASDAQ, and a really big blow off in the NDX. So I think that best case for the NDX here, just, you know, looking kind of talking Wyckoff, July, right at the beginning of the new quarter, we had a climactic surge. This is an automatic reaction in August, which says that we're range bound between these two extremes, more or less. We'll be bounded by those for a few months. And so we may fiercely rally back up to the resistance level, maybe even get slightly above it. And then I believe that it'll come back in and be in a trading range. And then this is my seasonality chart for 2023. Works so well in 22, but here you can see that it worked really nicely. This is the S&P, and look at the you know, how we had upward theme to seasonality in the first half of the year. Starting in August, we get weakness, and then range bound until November, December. And we did have weakness in the first part of August. And so far it's, you know, following the script. And I just believe that this is going to be range bound for stocks. But I think that the theme is rotation, that there's going to be some great rotation. And we saw that yesterday. I think we may have seen some of the early evidence of rotation. So
you're sanguine. A little bit of a pullback, but Bruce is pretty sanguine about the market here. So go ahead.
Yeah. Oh, and I was just, yeah. I like sanguine.
All right. Throw some sugar in there. All right.
This is the S&P, and this is a messy chart, and I apologize, but this is my working chart. This is the one that I label it. I put all my stuff. This is my distribution notes. I actually showed you this chart back in early 22 when the bear market was just getting, you know, some legs, and we talked about it. And and then I just keep updating as we go. Beautiful accumulation structure came out. Now we have, look at this big trend channel. And so we have the October low, beautiful divergent characteristics at the October low, beginning of the quarter. And then from the March low, this sets the stride for the advance. Well, look what we did. We went right up and we draw on the intervening high, we draw the parallel, and went right up and touched it. And when we touched it, you can see down here, stocks above their 50-day divergences are showing up at the time of the touch. That's an overbought market. And now it's working its way back into old resistance, new support, hopefully. And then the only other interesting thing here is,
so this could just be a correction to about 4,200 and then go again.
Yes, absolutely. And then here you have the NASDAQ 100, which is dominated by the mega caps, did not get to overbought like the S&P did. And we saw that the internal divergences it wasn't strong in the NASDAQ. But what was strong, this is the NDX stocks above their 50-day down here, this oscillator. So this is just the really big leadership names, and they got almost to 90% of stocks above their 50. But look what we've done here. In August, we weakened back down. Oops, sorry. And went back down to what we call the demand line, the green line, and touched it. Now we're rallying.
All right, let's wrap it. Let's see that point and figure you tried to hide away.
Yeah, this is good.
One X and O. All right. All right.
This is good. Only because it's two segments. This is the accumulation structure in 22, 23. Okay. Here's the target at 388. We got two 100s from hitting the target, so that's a hit. And but the more important thing, if we take the second segment, we get higher price objectives in the triple Qs, which is really the NASDAQ.
Really high. So so these recent exits down don't change anything.
No, I think it sets up a reaccumulation structure that may ultimately, when completed, give us a confirming count to this 532, 564. That's what I'm looking for.
Oh, Bruce, Bruce is a melt-up guy. All right. Well, anyway, don't have any ice cream. No. Melt up on you
instantly.
Bruce, great looks, really, and nice analogies and excellent presentation. Thank you so much.
Always a pleasure to hang with you all.
Yeah, really. Fun. Great work. And follow Bruce on Twitter, X at RD Wyckoff, and go watch him on stockcharts.com. He does some great work there, and puts out a lot of great research. And what's your website again, buddy?
WyckoffAnalytix.com. A lot of good Wyckoff work there that's free.
Yeah. So learn.
And my blog, my written blog which has a lot of great Wyckoff content on how to do it, is stockcharts.com under articles.
Okay. So he's a writer too. I don't know. What a renaissance, man. Okay. Well, Bruce, nice talking to you, buddy. I hope.
Oh my gosh.
Great rest of the summer, drawing to the close, and an excellent fall, and look forward to us.
Thank you, Dale. And
again.
Best to you all there. Always fun to get together.
Bruce Fraser, everybody. Thank you very much, Bruce.
Take care, everyone.
Great presentation. Watch this video again, guys, and you could join the team in 9 minutes for the morning edge. Don't just count your pips, count your blessings. And Melt Up Bruce will be back with us in December, right before Christmas.
With my ice cream.
All right. Adios, everyone. Have a good one. Thanks, Bruce.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.